invite you to come forward. We've got copies of our latest report on the first front rows, and there'll be more details of what we're going to discuss in there. So it's a good opportunity to get one of those copies as well. You're right in the middle. Ooh. For those of you joining us now, please do come to the front because there's some reports which will be useful for the discussions as well, which you can use. Okay. While everyone's getting their last coffees and desserts from the buffet outside, I'll start the session, and thank you all for joining us this afternoon. My name's Adam Cotter, and I head up the Asian office of this strangely named organization, OMFIF, which stands for the Official Monetary and Financial Institutions Forum. We have now been set up in Asia for the last 3 years. We're 10 years old as an organization. And our whole reason for being is to examine and analyze different issues that are very pertinent to central banks, but also other large public investment institutions such as sovereign wealth funds, public pension funds, development banks, and other international financial institutions as well. So the aim of our work is really to convene these different actors within public and private markets to discuss issues which are looking at areas of public investment, financial stability, and regulation. Now, of course, central bank, or should I just say digital currencies overall, have garnered a lot of interest in the last few years, and now central banks, even one may say, let's say 12 months ago, this was not on the top of their agenda. Ever since a large technology company said they may do something about a digital currency, it became to the fore of their thinking as well. So as you're, I'm sure, all aware, within this policy space, there has been much more discussion both on digital assets, digital tokens, digital currencies, but also the role of central banks in issuing these digital currencies as well, and what could be the benefits and challenges for central banks to pursue such a path. So what we plan to do today, we're going to have really a fintech stroke central bank digital currency 101, where we have a number of speakers joining us. This will be very much based on the research we've been doing jointly with IBM into central bank digital currencies, and I'm very pleased that Saket from IBM, who arrived just from New York a few hours ago, is joining us and has been a co-author of the latest report we've just released, I think several days ago, isn't it? We also have OMFIF Deputy Chairman Phil Middleton in the pink shirt, and he has been the leading contributor and thought leader into our work into this space as well. We're very pleased to have, I'm allowed to call you Oi, because that's your nickname, because everyone in Thailand has a nickname, isn't it? So that helps me with the Thai names. So we have Oi from the Bank of Thailand, from the FinTech office, who used to work in the payments department, so should know everything about different central bank digital currencies and payment systems. And we also have Mark Azir here, who's the director of the business strategy and technology department here at the ADB, who I'm sure is very familiar to many of you here as well. So what I would like to do to start proceedings is I'll give you a quick overview of how the session will unfold. So we're going to pass on to Phil first, who will give an introduction, an overview of our work so far in the area, but also where are we currently with central bank digital currencies, both in the wholesale but also retail space. I was then going to pass on to Ozir to see some of why is the ADB interested in central bank digital currencies, and we suggested that migrant worker remittances may be one area, but we can discuss others as well. And I know Ozir has some plans for that. And then Oy will be providing some inputs from a central banker's perspective, and then we'll go to Sakit for an overview of the further technology challenges involved. And then towards the end of the session, I do want to make this as interactive as possible. So if you do have any questions, please do let me know, raise your hand, and I'll try to get my attention in some way. And we'll have a Q&A session for the last sort of 20, maybe even 30 minutes as well. So I think in the interest of time, I'll pass over to Phil. Thank you.
Can I have the clicker, and the timer hasn't yet started, so I can go on forever. Right, is it the right-hand button? Right-hand button. Good afternoon, ladies and gentlemen. I, as usual, have picked the potentially worst slot of the day, which is immediately after lunch, when you're all feeling pleasantly relaxed and somnolent. So it's my job to try and wake you up a bit. I spent a lot of the summer, as Adam says, working on our latest report on central bank retail digital currencies, copies of which are here. And I can attest to the fact we could spend all week talking about this subject and still not get to the bottom of it, whether it's regulation, AML, CFT, technology, or indeed the use of it all together. So the objective really now is to give you a very 20,000-foot view, which is 7,000 meters for those of you who use that sort of thing, just to cover some of the major issues, cover some of the major conclusions we've come to, provide some points for debate and discussion. And please do debate and discuss afterwards. Please agree or violently disagree, if you will. The panel is up to everything. So, where are we? Principal conclusions. We are at the frontier of a payments revolution, a major upheaval in the way we transact, pay, settle, account for value. It will proceed at slightly different paces and in slightly different formats in slightly different parts of the world. But as Adam says, central banks all around the world are starting to sit up, take notice, and get very much involved in this. The major conclusions from the research that we conducted over the summer, which was with the kind participation of 25 central banks, interestingly enough, all of whom wish to remain anonymous, into developments and progress in digital currency. So conclusion one is, in the next 5 years, a central bank, a government somewhere in the world is probably going to launch a retail digital currency. It probably will not be a G20 country, but it'll be somewhere fairly close. It will be issued to meet a specific policy imperative. And you may well see multiple launches addressing different policy questions in different ways. We don't think that one size fits all here. This is not like Betamax and 8-track and VHS, where there is one winner in terms of an application, a technology, an approach. There will be multiple attempts, and in some places there will be failure. We're going to see an awful lot of pilot tests, sandboxes, experimentation, obfuscation. Some of it will go very well, some of it won't. In all probability, both the piloting and the eventual rollout, if it happens, will be a public-private partnership. Again, varying forms of that public-private partnership. It could be a technology firm providing the underlying platform and building the platform on which this digital currency is issued and run. It could be a partnership with the commercial banking sector to host retail accounts on behalf of the central bank and process. It could be a partnership with a telecoms company to provide central bank guaranteed digital payments over a mobile phone network. There is a variety of things, but we believe, and most central banks believe, they do not have all of the skills, all of the capabilities, and indeed all of the desire to do this on their own. Largely because they'd like to be left to get on with the job of central banking as opposed to the job of retail banking. Private stablecoin digital currencies in the retail space are unlikely, in our view, to be in significant usage. That's not the same thing as saying that private companies may not be running digital money, so we anticipate quite significant use of digital money on things like WeChat Pay and similar mobile or social networks, but they will be digital embodiments of fiat currencies and ultimately backstopped by reserves held with the central bank and ultimately convertible into fiat currency. We think that crypto a la Libra stablecoin currencies are highly unlikely, not least because most governments and most central banks don't want to see them because they undermine monetary sovereignty. And in our view, and in the view of many governments and central banks, money is a public good provided by the authorities. A credible, legal, stable means of exchange and account almost ranks alongside the ability to provide defense and other social services for citizens. It's an ultimate expression of sovereignty. And I think if you cannot protect the currency, there are some very serious questions about your ability to protect sovereignty, which is why I believe that central banks are and will continue to frown on private cryptocurrencies, which is not the same as the sort of Bitcoin, Ethereum type cryptocurrencies, which will remain, but as speculative digital assets. And there are a number of central banks, including, if I may say, Thailand, that have very highly evolved policies towards defining, regulating, and controlling these kind of instruments, and indeed the intermediaries that deal with them. And they are being dealt with, as the SEC has set out, as speculative asset classes that really your granny and your mum should not be encouraged to invest in. An awful lot of this discussion brings up the subject of blockchain and is often seen to be synonymous with blockchain. Our view is that blockchain is one of just several technologies that may or may not be relevant. Most central banks we talk to are increasingly technology agnostic in the sense that they say they prefer to work out the policy imperative, work out the practicalities, and then think about which technology best enables them to deal with that, rather than trying to deploy a technology in order to fit a solution. And the choice ultimately will be driven by government policy requirements, not by the technology. And Saket will be talking to us a bit more about that, and will be answering all questions of a technical nature, which I can't. Wholesale digital currency is stuttering. There were initially massively great expectations for distributed ledger technology, as it was called. Removal of centralization was seen as a great and good thing. It hasn't taken off as much as possible. We have seen things like the JP Morgan coin, the USC coin. There are groups of consenting adults, mostly investment banks, who are working on projects to try and improve exchange efficiency amongst themselves using tokens or stable coins. There are big problems with the technology. There are big problems with the regulation. There are very big problems with convertibility. So the ECB is on record as saying, if you want to trade blue marbles amongst yourselves, that's fine. We have no problem with it. But please do not call them euro marbles, because we, the central bank of the euro, refuse to underwrite it. And that's the big problem. There is some progress being made, but at a less rapid rate than used to be the case. But today we're talking about retail. Cryptocurrencies, as I've said, are a complete distraction. They are not really part of this discussion. They need to be regulated as speculative assets, not treated as coins. And I think all regulators around the globe are starting to agree on that approach. They're not a means of exchange. They're not a store of value. They're not a unit of account. They pose a threat to both monetary sovereignty and stability. At best, they're a speculative asset. At worst, they're a criminal enterprise. However, in fiat currency, there is a revolution underway. There's a declining use of cash in many advanced economies. An awful lot of existing payment systems, RTGS and the like, are starting to creak and need upgrading. There are new technologies coming, and there are new preferences in financial behaviors. For me, money is not money unless it has a picture of Her Majesty the Queen on it. For my daughter, money is something on one of these that she taps on one of these when paying the Uber driver for a box of burritos or whatever it is. So that there is a very strong consumer push, as well as other reasons for moving to different forms of payment and uses of technology. So there are multiple policy choices that a central bank can make. And I think we would say, one, you probably can't do all of them at the same time. You need to prioritize. Two, one size does not fit all. There will be differences depending on what you're starting, where you're starting from in terms of technology, history, culture, economy, national priorities, type of government, etc. Some of the choices you might make, you might want to replace cash. You might wish to overhaul your national payment system or your international payment system. You may have concerns about money laundering, countering terrorist financing. You may have concerns about the black economy. One nation I've been working with recently, the central bank said, you know, the biggest supporters of a digital currency are the tax authorities and the police, simply because of what it does in terms of transparency and control. It may be to promote financial inclusion. You can also argue that actually digital currency could promote financial exclusion. Discuss. The technology illiterate may not wish to use electronic means. Clearly, it adds some new monetary policy tools as a central bank. You can do negative interest rates at the drop of a computer button. You can do helicopter money at the drop of a computer button. You can do quantitative easing a lot more easily if you don't have to use cash. So there are all kinds of wonders for central bankers, which is actually one of the reasons why communicating and explaining to the electorate is going to be a massive major challenge if a digital currency is to be rolled out. Many politicians have reservations about the real motives of central bankers and ministers of finance for deploying digital currency. One policy opportunity that we looked at and continue to look at is migrant worker remittances. In the ADB region, there are significant remittance flows from migrant workers. They have very, very high transaction costs. In some cases, average for a migrant worker is 8–9% charges on remittances flows, which disadvantages the least affluent. And those charges are rising because a number of banking groups are withdrawing from correspondent banking and cross-border retail movements because of tightening regulations. It creates AML, CFT issues for regulators. It creates some serious reserve management issues for central banks. A thought. A central bank-owned stablecoin platform for handling migrant worker remittances, disintermediating the private sector, reducing the cost, promoting financial inclusion. Just a thought, really, and one I hope we can discuss and take up later. But if you look at the flows here, this is selective. Almost 10% of the GDP of the Philippines is migrant worker remittances. If those are being charged on an average of 8%, the impact on GDP is quite considerable. If you could reduce those down to 50 basis points, the impact on the economy would be considerable, the impact on financial inclusion would be considerable. And if you could imagine a platform jointly owned by central banks throughout the region, operating through stablecoin on a netting basis, that could be something very, very powerful, and indeed, if sponsored by somebody like the ADB, could be seen as being neutral and beneficial to all. I just throw that in as an idea of the sort of application that might be considered. Also, to highlight the issue that digital currency development by a central bank cannot remain a domestic issue for very long. International cooperation is going to be needed, quite considerable international cooperation, even if it's only to agree on terminology and basic standards for cross-border. So, yes, there are some national policy objectives and applications that are possible to look at, but at some point, conversations between central banks and agreements between central banks are going to be essential. Finally, just some further questions. If you're launching a retail digital currency as a central bank, is it going to be account-based? Every citizen going to have nominally or actual an account at the central bank? Or is it going to be value-based? Is it going to pay interest? What are the questions about transparency? How open should ownership be? Should it be like cash, an anonymous bearer instrument, or should the central bank have some view over the transactions and the parties involved in them? What about cybersecurity? If your entire currency network were digital and heaven forfend some malevolent force managed to hack into it and take control of it, what are the implications there? What might you do about it? What about financial exclusion? Interestingly, in Sweden, the Swedish central bank was looking to replace cash because